Hey guys, welcome to our money market update. What a different week it was this week. A couple of down days, a couple of up days, a couple of average days. Friday was pretty flat. The market really doesn't know what to do. There's a few recession fears around given the fact that inflation is so high. A few traders are looking beyond that, saying that we're not going to have a recession because exceptionally strong US growth, high oil prices, high inflation. I still think the market is going to see some volatile days and weeks ahead until we get some clarity around inflation and the fact that we are not going to see any sort of recession in 2022. So until we do see that, I expect prices to be up and down. Certainly, one could argue the previous week and this week have been pretty positive. Puppy dog's having some fun. You know, one of the interesting developments late in the week, of course, Joe Biden went across to Europe for the NATO summit. And I noted on Friday that the US has signed a deal with many European leaders to supply them natural gas and some energy. So I expect that to likely going to be a positive for US energy producers. We own one that's done exceptionally well in 2021 and 2022 so far. So there's certainly ongoing developments there. But well, as I said before, when you've got that backdrop of high inflation, the backdrop of what's going on with Ukraine still, the uncertainty of when is that going to end, you've got a market that's still a little bit jittery, but at the same time, there's so much money sitting on the sidelines, so trillions of dollars of cash sitting on the sidelines, and the minute you get some good news, that money starts to come back into the market. All right, so what's going to be key over the course of the next month, I'm really talking about into April now, which starts on Friday, is what is the next US inflation report going to say? Is it going to be higher, and is it going to spook investors into thinking that we might move towards that US recession? It's interesting, the minute that I talk about this sort of stuff, a lot of people think, oh, he's predicting a recession, he's predicting share prices are going to decline very sharply. I'm not predicting that at all. I'm just wanting to actually prepare myself in the event of if we were to see high inflation for longer periods of time, to make sure I've got plenty of cash on the sidelines to be able to put into some great quality companies as this tide comes in. All right, let's get up to the house and have a coffee because I want to share with you the number one metric that you want to make sure that you look out for whenever you're looking to buy a business. All right, so let's get into our trading tip of the week. If there is one metric, one important component of due diligence and choosing a business to own, it's the one key important metric of return on invested capital, or ROIC. If you own businesses that have higher than average return on invested capital percentages, so as an example, the average S&P 500 company or the average business listed on the New York Stock Exchange has a return on invested capital percentage of just under 10%. Okay, so that means that for every $1 that is invested in the business, what percentage after tax does the business produce? So a return on invested capital percentage is a good indication to how well the money is spent and the profit that is generated from that money. Now, the businesses that over time have shown to have higher share price appreciation, higher dividends, and a much better return on investment are companies that have high returns on capital. So in other words, the return on capital is well above 10%. So for example, Apple is over 20%, Alphabet is over 20%. The types of businesses that have returned investors like myself multiple years of higher gains than the average index value If you just simply own a portfolio of companies that return high returns on capital, you're going to have a portfolio that outperforms the index. So it is really Warren Buffett, the greatest investor of all time. He says the one key important metric is make sure you understand what return on invested capital is. And I would say 98% of people that invest in the share market have got no idea. Here at Trading Mastery, it is one of the key components of our 14-point checklist. We go through and check off 14 points, and one of those points, does the business return high returns on capital? So for example, if the business was to make $1 billion, it paid out some of that money with dividends, and it had, let's say, $500 million left over that it was going to reinvest in the business, what does it return after tax? So if it returns 27%, like a business like Home Depot does, that means that for every $100 invested in the business, after tax, the company is earning 27, which is well above the 7 or 8 of the average business. So high returns on capital. Now, what's coming up in the week ahead with respect to the economic calendar, and what can we expect? Let's get to that now. All right, so what is coming up this week on the economic calendar? As an investor, you always want to know what is driving prices. Sometimes that can be something like a geopolitical event in the short term. We want to be able to control our temperament and understand what's driving prices higher and lower. So let's actually have a look at that now. I've just made some notes on my phone about what is coming up this week. So the economic calendar is pretty clear in the first couple of days of this week, but when we get to Wednesday, we've got US consumer confidence and US GDP. That's two important numbers, but not going to be as important as the number coming up on Thursday, which is the US Personal Consumption Expenditure Index, which basically is the US Fed's guide on inflation. And this is going to be the elephant in the room in the coming week ahead with respect to what that number says. If it's higher than the Fed expects, then we're going to have a problem with markets, because what we're going to see is traders start to price in the expectation once again that the US is going to see some troubles with respect to growth. Of course, a recession, by the way, as many of you know, is 2 consecutive quarters back to back of negative growth. We're miles away from that now. There is no genuine fear of a recession yet. But if inflation was to stay high for the rest of this year, then that would be a problem. So that's going to be a really key number on Thursday. And on Friday, we'll get the latest US unemployment numbers. Now, US unemployment right now is well under 4%. So the economy is moving towards 3.5% unemployment rate. And that really is classed as, in financial markets, pretty much full employment. Basically, if you live in the US and you want a job, you can get one. Pretty similar here in Australia right now. And by the way, Australia is likely going to see rising inflation, higher interest rates, and the same type of pent-up demand from consumers spending their money as we've seen in the US in the past 6 to 12 months as well. So there you go. It's all happening. It's been a bit of a topsy-turvy week in the past week. I suspect that we might see that continue. Keep up to date with me here at Trading Mastery. And of course, if you haven't yet downloaded your 7-part mini course on how to get started and how to get investing the right way, make sure you get across to our website, tradingmastery.com. There'll be a link in the description section of this video. Have a great week ahead. I'll see you next week.